Ladies and gentlemen, dear colleagues and friends, good afternoon and welcome to Dublin City University. My name is Federico Fabbrini. I am a full professor of EU law and the founding director of the Brexit Institute, and it is my great pleasure to open this event on financial services after Brexit. As it has often been the case with Brexit Institute events in the last 4.5 years, also this initiative occurs at a very timely moment. Today and tomorrow, the UK government and the European Commission are seeking to finalize their negotiation on the implementation on the protocol on Ireland, Northern Ireland, which remains one of the most contentious points in their relations. And as many of you know, this was the topic of the last event of the Brexit Institute just 2 weeks ago, where we also featured keynote speeches by Minister Simon Coveney of Ireland and the European Commission Vice President Maroš Šefčovič. Today's event instead focuses on another key area of EU-UK cooperation, and one which is profoundly affected by Brexit, namely that of financial services, financial stability, the role of banks and capital markets. Our ambition is to explore how the withdrawal of the United Kingdom from the EU and the lack of a new passporting arrangement under the terms of the Trade and Cooperation Agreement affects both the future of the City of London and the prospects of capital markets union in the EU. To discuss this highly relevant topic, we have put together un parterre d'exception, a very strong list of speakers. In particular, I'm truly delighted to welcome to the Brexit Institute Lord Jonathan Hill, who is connecting remotely via his phone. So unfortunately, we won't be able to see him, but we hear him loud and clear. As you all know, Lord Hill is the former UK appointed Commissioner for Financial Services, Financial Stability and Capital Markets Union, and more recently he was the chairman of the UK Listing Review. Thanks to his multiple experience, Jonathan is ideally placed to address both elements of our conundrum. However, let me also mention the other participants to this event, which include John Peet from The Economist, who will moderate the discussion and properly introduce all the other speakers, Deborah Hutton from Eversheds, Sutherland, Tom Hall from AIB, Valerio Scollo from GSK Stockmann in Luxembourg. They all have engaged with the Brexit Institute in the past, and I am delighted that they are joining us again today, together with my Brexit Institute colleague, Christy Petit, who is representing DCU in the panel. I will quickly hand the floor now to John Peet for a more detailed presentation of our keynote speaker kicking off our conversation. Before doing so, however, let me just take quickly the opportunity to thank warmly Eversheds Sutherland for accepting to sponsor this initiative, as well as to thank AIB and GSK Stockmann for providing long-term support to the Brexit Institute, allowing us to fulfill our mission of informing the public and enlightening the debate on this historical process. Moreover, allow me also to draw your attention to a new interactive tool that the Brexit Institute recently rolled out as part of its Jean Monnet Network Bridge. This is an interactive map on differentiated governance within the European Union and in its neighborhood, which you can see, I think, in the link circulated below. This offers easy access to helpful information on how European states inside and outside the EU are participating to a number of policies. Lastly, from a housekeeping perspective, let me also remind everyone that we are recording this meeting and that we will make it later available on our YouTube channel. It is absolutely great to see, I think, over 90, close to 100 attendees, which confirms that there is no such thing as a Zoom fatigue when events are high level as they normally are here at the Brexit Institute. So thank you all for participating, and without further ado, I'll hand the floor to John Peet, and thanks, John, for being with us this afternoon.
Well, thank you, Federico. And I would just like to say thank you to the Institute, not just for holding this conference, but for your existence. It has been my experience writing about Brexit in the UK for The Economist that some of the best work on it has been done outside the United Kingdom, and some of the best has come from Dublin. So thank you very much for being around, and thank you for your previous events. I won't waste much time introducing Jonathan Hill. Really, suffice it to say that it was obvious to anybody after the 23rd of January 2016 that financial services would be a big issue. Financial services is a large part of the UK economy, and financial services exports to the EU were and are very significant to the UK. And there had been a lot of discussion before the referendum about the future relationship of the City of London to, as Europe's biggest financial centre, to the European Union. So obviously we would spend a lot of time discussing this. And then, hey presto, because politics works like that, we spent almost no time discussing financial services, 7% of the UK economy. Instead, we spent a lot of time discussing something else beginning FI, which was fish, which is 0.07% of the UK economy. But that's how politics works. And that really is all I'm going to say by way of introduction to Jonathan, who knows a lot more about this subject than I do, from not just his time in the city, but of course his time as the European Commissioner in charge of financial services, and particularly in charge of developing the Capital Markets Union, which is still a work in progress now under Mairead McGuinness. So Jonathan, perhaps you'd like to introduce our discussion of financial services after Brexit with any thoughts you want to share with us.
John, thank you. And Federico, thank you for inviting me. I'm sorry not to, well, neither to be there in person nor to be visible, but I'm very much there in spirit. Let me just start, John, with a few thoughts and perhaps provocations to set some context. The first one is that I think those people who, at an earlier stage in the process, thought that once Brexit had been, quotes, done, close quotes, everything would quieten down and both sides would automatically get closer, and that the technical experts in London and in Brussels and in capital cities would soon sort everything out and everything would resume its former steady course, have been, I'm afraid, proved wrong. And so my first point would be, starting at the top level, relations between the UK and the EU have not settled down. I don't expect them to settle down anytime soon. And there are, as you're saying, John, really, structural political reasons driving the dynamic that are going to make the coming together difficult in the short and maybe in the medium term. So my first message is we shouldn't expect a more favourable overall context suddenly to descend upon us, which will make the resolution of financial service issues easier. Second point, as you said in your remarks, John, I think a number of us thought that financial services would play a much more important part in the negotiations that they did. The European side certainly did, because they thought that, and they always thought, and I saw this clearly when I was in Brussels as commissioner, that the Brits regarded financial services, the city, as the jewel in their crown, and that we were as obsessed with our place in financial services as some other capital cities were themselves obsessed about London's place in financial services. So I think on the European side, when I, for instance, became commissioner as a Brit, there was a great deal of sensitivity, much more excitement in the EU than there was in the UK, where it passed with resounding silence. So I think financial services, therefore, was always going to be one of the lightning conductor issues. And because of that, I never thought it remotely likely that the European side would make rapid progress on things like equivalence and so on, because since they thought it was Britain's most important strategic interest, that was obviously always going to be the last area that they intended to address. And I think that will continue to be the same. I think the psychology of the situation is that agreement on financial services will always be the last element in the pack of cards. So again, I think that's an important contextual point. In terms of where the Europeans now are and what their objectives are, back to Federico's point, I think they've basically got a three-legged strategy. The first is to try and make progress to, well, I think the phrase is complete the capital markets union, maybe strengthen it a little, but I think that is going to continue to prove a very hard task. The second element is going to be what inducements can Europe offer to companies currently based in the UK to move their operations into the EU. And then the third leg of the strategy will be what legislative tools can they use to apply pressure to force more aspects of financial services to move from London to the continent. And I think they will try to apply pressure in all three of those areas in the years ahead. I think what is very much in Europe's interests is that this process takes a long time. I think Europe needs as much time as possible to try and strengthen its capital markets union. And I think it doesn't particularly want the UK to develop a more divergent, competitive approach to regulating financial services in the short term. So I think that's where Europe is on it. And therefore, I think there's a kind of race likely to emerge as to whether the UK can make itself a more attractive centre more quickly, or whether the EU is able to make progress on its three-legged strategy more quickly. The main beneficiary of that UK-EU rivalry, in my view, is likely to be the US, not the EU or the UK. Then finally on the UK, what's their approach to financial services post-Brexit? I think I think of the policy approach more like a kind of pointillist painting, that when you're close up to it, there appear to be just some dots. When you step back, you can see more of a picture emerging. By that I mean that we haven't seen the development of a very clear and coherent strategy applied across the board, looking at things like tax, how do you improve the overall environment, regulation in a comprehensive way. But we've seen a number of initiatives that are clearly intended to make the UK a more attractive destination for financial services businesses. So the listing review that I was asked to carry out, the fintech review that Ron Khalifa has carried out. There is currently underway a review of the overall regulatory framework with the purpose of, partly with the purpose of trying to see whether one can increase the responsibilities on regulators to be more competitive in how they go about their job. There have been reviews underway of Solvency II, of MiFID, of various other aspects. So you can see building up a picture that is designed to make London a more attractive place to do financial services. But against that, I think you do have to set other developments in other policy areas to do with tax, government intervention, and some greater political sense of a political approach to regulation overall. But again, I think when you look at the direction of travel with the politics in the UK, I think the dynamic is going to be to drive the UK to attempt to construct a more distinctive approach to financial services and regulation, to think about the new areas which have not yet been regulated, in, for instance, green finance or how you regulate fintech, and that over time we will find ourselves diverging more and more from the body of inherited EU law. And I think if you talk to people in the city, I mean, this would be my final point, the mood amongst practitioners, I think, has been shifting gradually, and over the last couple of years more significantly. So whereas immediately after the referendum, I had lots of conversations with people about how are we going to get equivalence, how will we stay close to the EU, surely we'll stay in the single market. Now, I would say the predominant conversation is how do we identify new opportunities? How do we position ourselves as a global marketplace? How do we make ourselves more competitive? And so in the same way that Europe is thinking less about the UK day to day, I think in financial services, people are starting to think less about Europe and more about global markets.
Thank you very much, Jonathan. Very comprehensive comments, and I certainly would endorse your view that the relationship between the UK and the EU is bad. It's particularly bad with France, as everybody knows, which is an important country in the EU. But most people that I speak to, I think, share your view that if anything, it's likely to get worse before it gets better. So it's an unsettled relationship. I believe that I can take some questions if anybody wants to ask them in the chat function, and we may even, by the miracle of Zoom, be able to let people ask questions directly. And I know you don't have a lot of time, Jonathan, before we move into our panel. I'd just like to pursue one thought with you, if I can myself, which is that before the referendum, many people said, well, if we lose passporting and we don't get equivalence, we're going to lose a lot of jobs. People talked about 75,000 jobs leaving London and moving to places like Frankfurt, Amsterdam, and indeed Dublin. Most of the commentary that I've read suggests that actually there has been much less in the way of jobs and business moving than people expected. Do you think that's true? And do you think that means that the city is a little more complacent and less worried than it was about its life after Brexit?
Yeah, so I think it's, I mean, on the numbers, I think that is broadly true. I mean, the latest numbers I've seen, you would have seen them, John, others maybe more up to date, were about 7,500. I think the think tank New Financial do good work on this, and it's sort of estimating the number of jobs. So, but that's about 10% of what the predictions were. And the other thing I think point that's worth making is that jobs that have moved haven't all moved to one place. So I think some of my friends in Europe thought, you know, fantastic if Britain's made this decision and they've left, this is our chance to get London back to Paris, say. Whereas in fact what's happened is that bits and pieces have gone to different cities, to Frankfurt, to Paris, to Amsterdam, some to Dublin, it's to Luxembourg. So the basic problem that Europe has suffered from for a long time of fragmentation has not been overcome. So I think your basic analysis is correct. In terms of does that make the city more complacent, I don't think it does, because although it's more modest than predicted, so much of the well-being of the centre is to do with momentum and to do with confidence. And I think on that question of momentum, I'd be looking more at, so is the momentum moving to the US or to Asia rather than is it moving from London to other European cities? So I think on London to other European cities, there's not that much momentum. from London and Europe to other global financial centres, maybe that's more of a problem. So I don't believe the city is complacent. I think it's quite keen to see the development of policy ideas that would make the City of London more competitive.
Yeah, and I have got a question coming in the chat, so more questions, please. And you tell us when you have to go, Jonathan. My other question for you was actually precisely what you just said. Do you think the EU still sees London as an asset to Europe, or do they just see it as a competitor? Because the point you've been making and others have made repeatedly is that actually this is not a zero-sum game in which losses to London immediately become benefits to somebody else in Europe. The people who may benefit from, in a sense, the sort of breakup into multi-financial centres are not European at all. They are New York, obviously, but also, you know, Singapore, Shanghai, and other places. And Europe as a whole may lose out from this process. Do you think that's perceived in Brussels and other parts of Europe?
I think, as always, it depends who you talk to and in what spirit you talk. So intellectually, rationally, economically, I think that's completely perceived by my old officials, by the people dealing with this most directly. But as I think you were implying, John, in your remarks, in the contrast between financial services and fish, that economic rationalism has never been the most important factor over the last 5 or 6 years. So the politics, the economics are completely clear, as you say, that London's loss is Europe's loss and will mean the cost of capital for European corporates and therefore for the European recovery and growth is going to go up, or would be likely to go up. And Europe as a whole, which is wanting to, rightly be more assertive in the face of Chinese and American assertiveness, risks being less able to fund its economic growth without London than it is with London. So I think the economics are pretty clear cut, but the politics are pretty clear cut the other way. And were one to be able to overcome, to be able to achieve those economic upside, you've got to get the politics of Europe into a completely different place. And as we've already said a number of times, the politics are in a bad place. And in that situation, will people in Europe cut their nose off to spite their face? Yes, 100% they will, as politicians, in the same way as you could say that people in the UK have been doing it the other way around.
Okay, I see that point. If you've got time, Jonathan, we've got 3 quick questions. We can.
Yep, I'll try and I'll take those, and I'll try and be quicker in my.
Okay, that's fine. A fairly simple, straight question from Ian Cooper. He wants to know, why did you choose to resign in 2016? The European Commissioner for Britain would have continued, and indeed did continue. Did you feel that your position was just untenable after the referendum?
Yeah, two points on that. Firstly, I thought it was important that something was to change as a result of the referendum. And although on one level, clearly I wasn't kind of personally responsible, one of the accusations against the European Commission and the whole system is it's not accountable and people don't take responsibility. And I just thought it was extremely important that, however imperfectly, I sort of demonstrated that I recognised something had changed, and that my fellow countrymen had decided they wanted to leave, and that simply to carry on as though nothing had happened wasn't the right thing to do. There was a more practical point as well, which is it was inconceivable that a Brit would have been able to carry on doing financial services after Brexit, utterly inconceivable. And so the first thing that then would have happened, I think, is that the Brit would have been kind of, whatever verb you want to use, humiliated, stripped, put in charge of paper clips, which would not, I didn't think, have been a very good way to kick off what I hoped at the time would be a process where you needed to get people talking together sensibly and not taking postures. As it turned out, I often accuse others of optimism bias over the last 5-6 years. My optimism bias was that I thought we would have a more honest discussion on both sides of the channel about what had happened and how to get to a new relationship than we have so far managed to do.
Fair enough. And Federico wanted to ask a question. I mean, Federico, do you want to put it, or shall I just?
I can formulate it if you want, John. Thanks, yep. Jonathan, for your remarks. I wanted to follow up on a point you've made about the future of capital markets union in the EU, and you've been pretty critical or pessimistic about the potentials there. And I just wanted to ask you in what ways the Next Generation EU Recovery Fund and the massive need for financing of the EU recovery instrument might, in fact, create a new incentive for Europe to push forward in that area despite all challenges.
Yeah, so I don't mean to sound critical. I mean, it's more, as you say, sort of, pessimistic. And that's, I think, based mainly on the practical difficulties that one has to overcome to try to get very different systems with very different traditions and rules, for example, on solvency, which was one of the ones that when I was trying that things founded on. It's extremely hard to overcome the barriers, and as you know, Federico, in European politics, if you are to overcome these barriers, you have to be able to see some immediate either economic or political upside in order to soak up all the pain. And I think the difficulty with this, particularly given there are many countries, and Germany would be an example of a big one, that don't have a strong capital markets tradition and are much more geared towards thinking about banking and the role of small banks and family banks, that to get critical mass and momentum behind the moves you have to take is really difficult. And so that for me is the fundamental problem that has to be overcome. It's clear there's a need for it. It's clear that there are opportunities for funding that arise from it in the way you described, Federico. But the politics, particularly when they can't make progress on banking union, I think are just really difficult.
Okay, one more question, Jonathan, if you've got time.
Yeah, that's fine, and then I'll
that'd be perfect. Well, it's actually from Christy. I mean, she wants to know particularly what impact Brexit will have on the setting and implementation of global standards. For example, the Financial Stability Board, where the UK and the EU will now be in the room as separate members. Will they work together, or will it be more difficult?
So, I think first of all that the UK and all the UK regulators I know will be completely determined to be part of the global regulatory standard setting process. So I know that some people think that the kind of one of the consequences of Brexit might be that the UK generally and the UK regulators want to kind of break off on their own and create Singapore on Thames and have a huge bonfire of red tape. I think both obviously for reasons of access to global markets, but also the psychology of regulators. I think that is a very long way from the minds of regulators. So I think the UK will want to continue to play an important part in global regulatory bodies, and I would be astonished if most of the time at the kind of principal global level, the UK and the EU weren't very much on the same page. I think the issue will come where some of those principles are translated into practice. I mean, we already know in kind of banking regulation, post-crisis, we have global standards, but then how those are applied in individual markets can differ quite a lot. So I think it's in the area, in that area where, I think the way the Brits will be likely to develop things, I do think might be a bit different from the EU. Again, this isn't a criticism of the EU, but a consequence of its structures, consensus-based system, a pretty prominent European Parliament with its own objectives and agendas, means that when you regulate in Europe, it takes a hell of a long time. It's very difficult to adapt once it's enacted because of all the compromises that it has entailed. It's quite legalistic, quite technical, quite prescriptive. The opportunity, I think, for the UK is that you should be able to move faster. You should be able to be more flexible. You could develop regulation that's more proportionate and adaptable. So I think that's where the differences of emphasis might come. And then I also think in those areas that aren't yet regulated, because I think so much of this debate, we look, as things stand or as things have been, and we're not thinking, actually, the whole financial service sector is going to be massively disrupted by innovation, by blockchain, fintech more generally. And that's going to have to be regulated in a way we don't yet know. And there, I think, that how those global standards are developed, I think the UK will want very much to be at the forefront of those. But again, I think on most issues, the UK, the EU are more likely to approach things from a similar kind of set of values than maybe UK and parts of Asia. So I don't expect, Christy, that there'll be a big turning of the backs of UK regulators. On the contrary, I think they'll be really keen still to be in global fora.
Okay, I think that's a very good note on which to thank you very much, Jonathan. I mean, we did have a couple more questions, one of which was what was the best way of improving relations between the UK and the EU? And I think the answer to that is both sides need to compromise. But
yeah, and talking to each other quietly, not shouting, might help. I mean, yes. I think one of the things that strikes you, I know, John, because we discussed it the other day, and me, is that that whole sort of web of private relationships and back channels and business contexts and all the rest of it, connections, but particularly amongst politicians, it just feels like it has atrophied. And there's an extremely strong case for just some basic hygiene of good relationship and diplomacy to be rebuilt, but it's not going to be rebuilt until the top level relationships improve. And so I think, we can all see some of the things that ought to be going on, but if you have a fundamental trust problem, I don't think that will be addressed until some of the current individuals are in different jobs.
put very diplomatically, Jonathan. my own view is that keeping off Twitter might be a good idea for politicians as well.
Well, not just for politicians, John.
Well, on behalf of everybody, thank you very much for those remarks. Sorry we couldn't see you, Jonathan. Thank you very much for introducing our conference, and we'll move on to the panel. So, Federico, do you want to say anything else before we move on?
Just to thank Jonathan, and I'm sorry you couldn't be on screen, but we're delighted you could be with us.
I miss it too, but at least you haven't had to look at me. And I hope before too long, Federico, maybe we can actually do something in person. But thank you for inviting me, and good luck with the rest of the conversation. Thanks very much.
Great. Well, I think we move straight on to the panel now. And I think some of them, I'm sure, will pick up some of what Jonathan Hill has said in his introduction. We've got, as Federico explained, we have 4 excellent panelists, starting with Christy Petit, who's also from Dublin City University at the Brexit Institute, then Valerio Scollo from GSK Stockmann in Luxembourg, Tom Hall here in London from AIB, finishing with Deborah Hutton, Eversheds, Sutherland. And each of them is going to speak for something like 7 minutes. And then I hope we have a good half hour for questions and discussion. So as we go through the presentations, please, any of the participants, I'm glad to see there are still over 90 of them, please put questions or comments into the chat, and we will take it from there. Christy, you can begin.
Thank you very much, John. Thanks for the opportunity to take part in this panel. So we are about to reach nearly a year without single passports. Indeed, since earlier this year, UK financial institutions have lost a passport to provide financial services in the EU, and they can rely only on a very limited set of equivalence decisions to access the EU's single market. So the city is an offshore financial center for EU-based entities, and the UK is treated as a third country. And due to all those aspects, some consider that we are actually in a situation of a hard Brexit in banking and financial services, and many effects are still to come. So in those 7 minutes, I will address 3 points, one related to equivalence, one related to some regulatory divergences in financial services that were actually mentioned by Lord Hill in his keynote, and a final quick point on cross-border cooperation. So regarding equivalence, without going into the conceptual aspect of it, it's critical because it has advantages on both sides, for the EU and for the UK. It's meant to reduce or even eliminate some overlaps in compliance requirements for the market players. It's meant also to allow, to some extent, to benefit for some more favorable requirements, and so on and so forth. But there is only one equivalence at the moment. There has been another one, but it has expired, as we know, since July 2021 for the central securities depositories. I'm pretty sure that one of my fellow panelists will get back to that on the more technical level. And there is one which is granted for the use of UK clearinghouses for derivatives transactions, which is granted until the end of June 2022. And we already know from a recent announcement from Commissioner McGuinness that there is an extension that will be announced and proposed at the beginning of next year in 2022. So as John encouraged us to think, what does it mean also on the EU side? So for the EU financial single market, there is also some intense work in progress in this regard, because you may extend this equivalence, but it also means that you need to decide for a date. And deciding for that, it's also preparing the EU to have a stronger but also more attractive central clearing capacity on the continent. So with the willingness, the political willingness, but also at the technical level, the capacity to depart from this over-reliance on the UK, that raises some issues in terms of financial stability. So there is some ongoing work among several EU institutions to build up domestic capacity in terms of liquidity for EU CCPs, and also to have to expand the range of clearing solutions on offer within EU infrastructure. So this would be the first pillar, and actually that was emphasized by Commissioner McGuinness in her statement earlier in November. And the second pillar relates to supervision. And surprisingly, when you are building up this infrastructure, you need also to monitor and manage the risk that may stem from those entities. So the framework for the supervisory framework for CCPs at EU level is still to be built up and constructed further. So those aspects would be for the EU level. And turning to my second point, so that was for the equivalent granted and what it means when we look at the extension. If we look at the regulatory divergence dimension within the financial services sector, there is some ongoing work led by some peers, especially at King's College, I think. So a divergence tracker, very useful document where you see indeed some of the areas that Lord Hill mentioned. So the UK plan for strategic approach to fintech. And secondly, the review of Solvency II, so for investment firms, to what extent that this piece of the legislation can be adapted and tailored to the UK needs. So without going into details, I just wanted to say that in this exercise, of course, you can identify to some extent some divergence, some different distinctive approaches, but at the same time, if you look at the context, the review and the policy recommendations and the evolution of the framework is coming also at the same time as when the Commission launched some proposals also in that field. So the exact name is the EU Digital Finance Strategy, also as regard retail payments. The package was launched in September 2020. So we could have a more nuanced approach. So there might be some divergence regarding some regulatory sandboxes and the innovation hubs, etc. But to some extent, the idea is the same, also to facilitate some innovation for the products, services in this area of fintech. So that was for the first point of the fintech plan. And the second one concerned the ongoing review from the Treasury for the regulatory framework as regards insurance firms. Here, the approach is definitely diverging. Indeed, the overall aim is to have lower requirements for those insurance firms, and it's considered to be safe from the perspective of the UK government. But at the same time, I've seen that the Bank of England Prudential Regulation Authority expressed some concerns as regards the changes that could be provoked as a result of this review of Solvency II. So that was just to flag this second element of regulatory divergence, and something which is maybe bridging those two dimensions, just to finish on this second point, is a remark on something which is to be further developed, and it's concerning the financial services regulatory cooperation. So at the same time that there was this EU-UK trade and cooperation agreement that we're all aware of, there was a joint declaration adopted by the EU and the UK on this regulatory cooperation, with some commitment for more transparency and also dialogue on equivalence decisions, etc. I would say that it's more loose at the moment, and we are still lacking the publication and the signature of the memorandum of understanding, which is attached to this regulatory cooperation. But that was just to flag this ongoing work. And being conscious of the time, I promised to be very short for the third point. I just wanted to bring in something which is also related to what Lord Hill said in his keynote, the willingness and probably the stance of the regulatory authorities, but also supervisory authorities, to still converge, to still build bridges, and to still have those elements which are helping the entities to operate on a cross-border basis. So this is what I mean by cross-border cooperation of authorities. I'm happy to develop further if some participants are more interested in those areas, but it's basically related to the setting of memorandum of understanding and the continuity of the work of all those authorities within this sector, within the financial services sector. And now I stop because I see John unmuted.
Okay.
Thank you.
Well, no, that's great. Thank you very much, Christy, for those comments and those three particular points. We move straight to Valerio, Scollo, GSK Stockmann.
Many thanks. Many thanks, John. Can you hear me well? Okay, good. And sorry in advance if the line will drop, but our IT system has an issue with Zoom. Well, first of all, let me start by saying that it's an immense, it's a privilege and an honor to be here and to listen to Lord Hill keynote speech. Very inspirational, very interesting, very deep. It's such a disgrace for the EU that a person like him can no longer be a EU commissioner. And that brings me to the, let's say, the main consequences of Brexit, at least from my perspective, when it comes to capital markets and capital markets union. I would like to continue with a quote from a former colleague of Lord Hill, Frans Timmermans, who wrote in March 2017, just after the divorce papers were presented to the EU Commission, that from a global perspective, the EU has two kinds of member states: small ones and those who do not know yet that they are small. And this clearly applies to each state of the European Union, but it applies as well to the UK. And it's a key element, key point of capital markets union. Why? Because capital markets union rely on the capacity of capital markets, rely on the possibility to pool capitals in order to find the most efficient allocation of resources. So the capacity of the European Union to pool assets has been clearly damaged by the Brexit. Why? Because on one hand, a large part of capitals are sitting in the UK. On the other hand, and this is for me the key element, is the pool of talent you have in the UK and the capacity of the UK to structure capital markets products for the European Union. Now, a lot of this is still working after Brexit, because it's either part of the unregulated sector or simply because people are being delegated by regulated entities to perform their structuring activities, much like you would do with the US. However, it's becoming more and more complicated. It's becoming more and more harder to operate efficiently. The consequence of that is that several players are clearly moving out of the UK. It's not something that happened immediately as expected, but is happening and is likely to continue. And that's unfortunate, because it's important for capital markets to have a clear reference point. And what certainly European Union is missing with Brexit is, as I said at the beginning, people like Lord Hill with the right mindset, with a clear vision on the importance of sounded regulation for financial services. If you have a look at, there is one report from ESMA which I read very carefully every year, and every year with, I must say, more sadness, is the report on the number of prospectuses approved within the European Economic Area. And has been constantly the number of prospectuses approved. Prospectuses approved means let's say for the non-technicians, the number of securities that are going to be offered to the public or admitted to trading in regulated market. Being admitted to trading in regulated market means more transparency in the capital markets, means also easier access to capital markets for SMEs and the real economy. And if you have a look at the number of prospectuses, there is a constant decrease since 2007. There was a sharp decrease with the financial crisis, slow attempt to recover, and then constant decrease since then. That shows that there is an issue with the European regulation. If it doesn't allow issuers, market participants to access regulated capital markets, so the more transparent capital markets. And it's an issue that should be tackled by, again, sound-minded regulators. Another trend that I would like to flag as a consequence of Brexit, it's something I mentioned in 2018 at the Brexit Institute, and it's turning to be true, more and more true, is the relevance of English law for market participants. At the time, I remember it was, let's say, the reaction when I was talking about that was quite not so. It wasn't taken so seriously, and I remember at conferences in London, still in 2019, when it was possible to go, people saying, "Well, why we shouldn't continue using English law for European transactions?" Well, it turned out as of 1st of January 2021 that court decisions rendered in the UK are no longer directly enforceable in the rest of the European Union. That's an issue. That's an issue because you have several instruments for capital markets which are governed by English law, which in case of litigation would see a decision rendered by an English court that could not be directly enforceable in the rest of the European Union. The consequence of that is that on one hand, European institutions, let's say, they already switched to different laws for their financing products, also for political reasons. But that is something that could be expected also for, let's say, for private participants in the future. And that's something that to be taken into account, because that can have an impact on the pooling of talent in the city when it comes to structuring products.
Okay, well, thank you very much, Valerio, and thank you very much for bringing in the legal point at the end, which is, I think, an important one. We're going to move straight to Tom Hall from AIB.
Good afternoon, everybody, and thank you to the Brexit Institute for giving me the opportunity to join the panel. Thoroughly enjoyed Lord Hill's remarks. Just to draw on some of those, potentially, you know, the regulators, in my experience on the financial services side, have done got a good job in the lead up to Brexit. They didn't jump as the mood music swung around. We thoroughly enjoyed the support we got from both sides as we went through. I think the overall stability was front and centre, and hopefully that will remain so. As Lord Hill remarked there, that, you know, they think they see the big picture here, and the politics won't get in the way of that. And in terms of the attitude of both sides to progress, yes, the EU is moving slowly, and I think that, as he says, is to their benefit. They're recognising equivalence on a rolling basis on a number of key items. And similarly, the UK does want to diverge, dying to diverge, but is scared of moving too quickly on items such that the EU feels it has to take the third action that Lord Hill talked to, which was actually legislating for change and accelerating the movement of potential individual verticals within the financial services industry into the EU. Yeah, the CCP issue that Christy talked about is an interesting one. We took the approach as an EU bank to move our clearing into Eurex at the guidance of the regulator. We referred to the inducement or the persuasiveness to move things across. But that's a cost we're absorbing now, because the LCH, the London Clearing House, actually for the corporate and SME side of the market who want to hedge against higher rates, is actually a cheaper venue to clear through. So we are having to reverse all our trades out of there as we do them and place them into Eurex, which is costing, you know, up to 3/4 of a basis point, which doesn't sound a lot, but, you know, it's an input, a cost we're having to absorb as an organisation. Even EU type transactions led out of London are being initially placed into LCH. So other EU institutions and the big clearing and the big players in London, be the investment banks or the UK clearers, are all still in LCH. And despite the drive to move to Eurex, from which was maybe 7 or 8% of overall volume, it's only got 20% of the EU market is now in Eurex, despite the soft nudging. And at some point, we really need a decision on that, such that we can not incur this cost, but still provide the best product to our customers and support them. Which is interesting, because if you think of the consolidated tape, is all about drawing together enough data across 500 different execution venues, so everybody can see what's going on, the best price to drive liquidity to the right space. Well, LCH clearly demonstrates liquidity, depth, fine pricing, etc., etc. And at the moment, we're in this limbo land where we're using Eurex because we know it's what our regulator and political people would like us to do going into the future, but that would be a good thing to sort out. In terms of the approach to the movement from being an EEA passported entity into the UK, we're now in the transition period. We're not through. We're definitely not post-Brexit. That will happen hopefully sometime next year. The regulator has upped the ante across the board for third country branches operating in the UK. It is minimal in terms of extra lift, and as long as they enjoy a good relationship with home state regulators, they're happy to take information from them and use that as an entry point for information, and only on occasion will they look for extra stuff. So again, they're trying to keep everybody on the pitch. Final point I'd make is around talent, and Lord Hill referenced the fragmentation across Milan, Frankfurt, Amsterdam, Paris, and indeed Dublin and Luxembourg of business, but also with the business goes the talent. And we'll have seen the first wave where people had names on seats. You will be moving when the business moves, and that happened. And there was lots of shiny dealing rooms built around Europe, and you saw that first wave completed probably around about the summer of last year. But you saw Christy and the guard coming out and say, look, you've built these shiny rooms, start putting more people in them. Well, the more people is going to have to come probably from these centres, and if you take AIB and Bank of Ireland as the sort of the main banks in Dublin, once you've moved your young people who are mobile and your people who had some link to the centre that you want to move them to, the easiest thing to do then is go and get talent from incumbents. It's cheaper, it's easier. And that's what we're seeing definitely. And if that wave picks up, that in all centres, that will be an interesting thing for domestic pillar banks, people in Paris, Frankfurt, Amsterdam, to manage their talent pools, because it would be hard to think that these smaller operations coming in will build a talent density themselves, which is resilient to change, retirement, movement, etc., etc. So they're going to keep coming back to the pillar banks who are continually training up and building talent. And for AIB, just in the context, obviously we don't pay variable compensation, so we're on the back foot a little bit. We're price capped on that. So for us particularly, it's hard. But I think in probably all centres, I think the price of housing, etc., has gone up, and therefore the ability to move talent, it's cheaper to get it locally. But we are going to come to a point where the replenishment of that talent on an ongoing basis is going to become difficult. I'm not sure how the fund management regime that they mentioned announced last week with 2 senior managers in the EU is going to work, because in my experience, for every job you need 3 people in sight for holidays, annual leave, and somebody choosing to leave. So 2 is probably 5, and that's quite an expensive pool. And what are they going to do, and what's their job title, and what is a senior manager of substance that will give the EU confidence that person can influence allocation, etc., risk on the ground in London. So still lots to play for. I'd say we are not, the title is post-Brexit, I would say clearly in transition at this stage. Lots to play for on both sides, moving slowly.
Well, thank you very much, Tom. Thinking about the need to attract talent in a high-cost environment, of course, in the Zoom world, we may be able to have a situation where people don't have to live in high-cost environments and can still work, which may make a difference if it lasts like that. But now, Deborah Hutton, to finish up from Eversheds, Sutherland.
I'm not sure what's left to say after hearing from our panelists. which is excellent discussion so far. But I'm actually going to start with a quote from John Hume, who I met as a student when we used to lobby, as students for peace. And it's sort of back to the discussion about what can we do to go forward and actually have a better relationship. And I love this quote. It's, when people are divided, the only solution is agreement. And it's about being good neighbors. And I just want us to remember, so I'm going to say a couple of things that's going to not be very politically correct. Bear in mind, I'm a lawyer. And the first thing I'm going to say is, when I was in London, I wasn't working in Eversheds Sutherland. I was working in the financial services sector. And one of the things one of my roles, side job, was letting go of 2,000 people. And it wasn't related to Brexit, but I was there while the votes were going on, working in a very, very senior position. And obviously the financial market participants that we're talking about, they didn't get themselves involved. There wasn't statements where you had the big banks and the insurance companies and the brokers coming out and the clearing houses saying what their view on Brexit was. Okay, so, but that 2000 was the streamlining, and as you're looking at what's going to happen in financial services more broadly, because financial services is moving fast. And even though if we look at London, and some market participants would say between 22% to 30% of tax is coming from London into the UK economy. Similarly, in Ireland, we're small, not with the same numbers as the UK, 16,000 jobs and everything we're doing in financial services. What was driving the Brexit vote wasn't really coming out of London, and that was shown in the vote. So whenever we talk about some of the politics that were going on at the time, of course the focus was on fish and not on financial services. There was a great study done by the EU prior to Brexit. And I always think this is really telling when we sit in that information bubble, if we're looking at AI or anything else. Of the 10 richest regions in Northern Europe, inner London, UK was one, the rest were Belgium, Luxembourg, Germany, Netherlands, Sweden, Austria. But of the poorest 12, 11 were in the UK and one was in Belgium. So that's what drove Brexit. So we weren't part of the discussion on financial services, but we are market leaders. And this is something I admire, and I've been looking at the attendees while I've been on this call, who have even dialed in today. And what I really admire about Irish funds, and I know I've worked with FAMA, I've worked with CSSF industry bodies in Netherlands, is how there's an education process about, I remember, in the last downturn, or maybe 2 downturns ago in Ireland, we were told, go out and support, our hotels and our businesses as to what, financial services can do. So it's asking a little bit more of us. And also, I think there's been some talk about the politics and having an honest conversation. And whenever you have an honest conversation, it's about being respectful. And let's be clear. I spent a lot of my career in the UK. The UK still, even with Brexit, is still leading in terms of fintech. It was the clearing hub. There is a lot of lessons to be learned in clearing, but we're going to have to talk on some statistics now. So first, what's happened from the UK? Have we benefited in Europe? But also, what are the unintended consequences? So if we talk about clearing, why is that so politicized? In numbers, now again, I'm not a statistician, I'm a lawyer, but we're talking USD 660 trillion in derivatives and clearing. When you're talking about that moving to Amsterdam, and I thought there were some really interesting comments from Tom, and we've heard the market participants saying, okay, yes, there was this 18-month break given by Europe to say, well, if you suddenly move that out of London, there's going to be cost, there's going to be operational risk. But the fact is, the way clearing works, and I'm going to be high level, so Tom can come and correct me, but it works on economies of scale. So fragmenting that causes a problem. And the London, with the expertise in that area, let's be frank, have said, listen, we're going to diverge from CSDR for a number of reasons. But that means people like Tom and other market participants are now looking at a dual regulatory environment as well. So that causes other problems. And yes, there is that push, but what's going to happen in June 2022? Because we're talking about Brexit a year later, but we're not, as Tom said, we're still in the transition. We look at sort of some of the work that I've been doing with my clients in terms of, you know, the type of business that has moved out of London, and some of the headlines have not been helpful. I mean, approximately 440 financial services firms in the UK have relocated business, staff and entities to Europe. Some would say Ireland is winning in certain scenarios. But let's put that in context. Yes, some of the stats are showing Ireland has got maybe a 25% increase in financial services. Are we rubbing our hands and being happy? No, because GDP is predicted to decrease overall, with other sectors impacted between 2 to 7%. Okay, so it's not all good. And arguing with your closest neighbour is not a great scenario to be in. 10% of UK bank assets totaling 900 billion or more are going to move to the EU. Is that necessarily good? 7,400 jobs to move or moved. Again, the question on talent, but if we look at COVID, remote work, and like the City of London, we've used that term a couple of times. It's not the City of Dublin, it's not the City of London, it's not the city of anywhere anymore. You know, talent is moving out, and I don't know if where there was restrictions, but a lot of people are saying, actually, I don't want to be living in the city. I want to be living further out. Amsterdam has replaced London as one of the biggest financial trading centres. And as I say, you know, finally, the equivalence decision, I mean, on clearing, I mean, the reality is that type of market intel and knowledge, you want to keep that door open for communication. And then the uncertainty. I've had clients who just go, I'm just so uncertain, but we're not always saying jump. We're trying to say, okay, is there some regime where certain services can still be provided in Ireland? Can you delegate certain out? Are there exemptions? Can we rely on reverse solicitation? And are there opportunities? And there's been discussions here around the whole the digital AI, digital currencies, digital assets, just the fintech area in its totality. And yes, the UK is still doing really, you know, well. And I said significant statistics from the first half of 2021 indicated, you know, the highest figures ever, sort of 5.7 billion of capital across 317 deals in the UK. So it's not all doom and gloom. And in terms of how you respond to some, you know, such fluctuations in the market, the skill set will respond. And, you know, but it's how do we get that relationship to the best position going forward. So I'm going to respond to some of the headlines, which I don't think have been helpful. And that's not a result of financial services, but it's more a result of how there's issues in terms of information bubbles, AI, and sort of what those headlines look like. So poor old Mr. Ferrandes Bollo has been quoted and warning in September banks should not be using cross-border regimes as a means to carry on large volumes of activity. And I've had clients go, this is quite a concern. And we're saying, no, let's not mix up reverse solicitation with exemptions that exist in law, that have existed in law for years to allow certain activity to be conducted. And I think to my friend Valerio, Ireland and Luxembourg have been singled out as being more flexible, when the reality is the reason we're singled out is Luxembourg and Ireland are two of the largest domiciles in Europe for funds. A third of Irish funds have UK managers. We have US managers, we have Asian managers. Our regime for using those managers to manage those funds has existed. We had a specific carve out in EU legislation way beyond pre-Brexit, before Brexit was even thought about, that enabled certain business to be done by non-EEA entities. And I would imagine, and Valerio can correct me, that it's very similar in Luxembourg. One thing that does sadden me, and pre-Brexit, I was so impressed that the UK created the first cryptocurrency regulated fund. Now, it had to close since. And it was such an impressive feat. And And it's interesting, maybe people knew we were all talking today in Europe, but a couple of key pieces of legislation and progression has happened. One is the markets in crypto assets and DORA that one of the other panelists, Christy, was talking about in terms of what are the objectives in Europe. We're looking at ESG, we're looking at digital currency, we're looking at AI and machine learning. What is holding these back is actually having a common framework. But things are moving really fast. And if we look at how fast some of this regulation is moving, it is, you know, in my lifetime, and I'm very old, this is moving faster than I've ever seen. And it's moving well. But a study only a month and a bit ago indicated that certain EU member states and participants in it were wanting some of that regulation managed at a domestic level. So there is an education process with our population. So this is where, and we have to remember, why are we talking about politics on law? Because law doesn't exist in a vacuum. We're all part of it. And then I just want to sort of wrap up and sort of say, you know, back to, you know, that respect, that communication. I mean, the UK has had a regulatory sandbox. You know, Ireland is wanting to continue that relationship. There can be more. We've talked about certain benefits, but the massive losses that come with not finding that agreement. And we have to understand that financial services were not part of the discussion. They were not part of the consideration. And unfortunately, this is now the time to lead. And in my career, you know, we've had to lobby for many changes, people on this call, and people even in fact that are listening now. And as I say, there's a real human element to this when we look at what's happening across that client base, of people losing jobs, the costs, the managing it. I'm actually dealing with clients that as part of their Brexit plan and say moved, I won't say to what EU jurisdiction, but then decided that didn't work out and are moving again. You know, so there's real human cost, and the leadership and find an agreement cannot be emphasized enough. So I think the discussion has been great. I scrapped my talk just to try and respond to some of what was said. So thank you, everyone.
Great, great. Well, thank you, Deborah, and thank you to all our panelists for very interesting discussions. I'm pleased if anybody wants to ask questions. We've got about 15 or 20 minutes. I think we can overrun a little bit for any comments or questions. I mean, I'm left wondering a number of things. Well, one of them is whether any of you think that the word strategic autonomy, which we hear in the financial services field, do they have any real meaning? I mean, why is the issue of clearing, for instance, a matter of strategic autonomy? We saw that Mairead McGuinness earlier in the week said, you know, the present situation is unsustainable. And yet the issue there, as Tom Hall was saying, is really about cost. So why should we apply strategic autonomy to something as apparently mundane as clearing? Do any of you want to comment on that?
Can I comment and then be corrected by Tom, or Tom, do you want to go first?
Go for it.
So I think Mairead McGuinness is not alone in terms of her concern, because Andrew Bailey of the Bank of England also has similar concern. In his speech to the UK Treasury Committee, he highlighted a consequence of no further equivalence for the 18-month period in relation to clearing would mean a quarter of euro derivatives would move from the UK to the EU. And he said that that's just essentially not viable, was the words he used. And he said the reason is particularly in an activity like clearing, where the efficiency really comes from having a used very big pool of derivatives. And he's trying to break it down for those not in this very complex area, that can be netted and cleared down. By splitting that pool up, the whole process becomes less efficient, and having the smaller part of the pool would mean it's even less efficient. And clearinghouses also involve a certain degree of cross-currency netting to go on that would break that down as well. So it creates ripple effect. And this is where there's a slight divergence in the UK, who has had the expertise in this area for so long, that they have identified, and as I said, when I was in the UK, we worked with these, and the amount of resources behind these industry groups to look at things, because they've implemented some of the legislation slightly differently. So just for those that aren't clear, the UK implemented certain European law into domestic law. So they've implemented CSDR slightly different into domestic law because there is a very contentious part of that, which is the mandatory buy-in regime. So yes, there are significant operational and risk pieces, but I don't know, maybe others want to speak, but who's got practical experience of this.
But perhaps, Tom, you could comment on this. I mean, because the other problem here is that if it becomes much cheaper to clear everything in New York, then people may say, well, look, maybe we should all arrange to go and clear stuff in New York instead.
Well, exactly, John. I mean, ultimately, if one puts up a barrier to the other between the UK and the EU, they are going to lose out to a third party, which they both find acceptable, which is a crazy state of affairs. I guess once you start fragmenting these clear, I mean, in and of itself, the clearinghouse is a great idea until you realise that there's one place where all the risk is. You go, really? So they are, talk about systemically important, super systemically important. They hopefully they balance themselves out. By the time, if you put some of the risk into Europe, then you get another pool of assets that goes wrong, and there's open risk in one and in the other, and who's left holding the baby at the end. And for all the players involved, ultimately you're writing the check. If all the initial margins you've all put in don't cover the loss, you're going to have to join in, and that's not a great position to be in. If you are part of the London one and the EU, that's fine, but the EU one's wrong. There's also the cost. I mean, for each trade you put in, the more you have, and that your net position is quite small, the less margin you have to put in, and less initial margin you have to put in. So that costs money. Okay, rates are negative at the moment, so the cost of it is surplus. We've all got current account balances in the clearing banks, huge amounts of them. But when you've got margins in two locations, that's just money just sitting there doing nothing. So that's the problem with fragmenting it.
Yeah, my other question I was going to ask any of you who have thoughts on this, it actually grew out of a slip of the tongue by Deborah. You mentioned GDPR as well as GDP. You actually meant GDP. And I just wondered about that. There has been the beginnings of a debate about the data adequacy decision and whether it's tenable, and whether if the UK diverges, the UK will lose data adequacy. Is that a potential problem for the financial services industry? Do any of you have views on that? Tom.
Well, it's a problem for everybody. Look, we're taking steps to work with all our suppliers, anybody who's holding data for us, to go through and ensure there are extra checks in terms of what is required on a case-by-case basis. But I think that's where it will end, and then it will become part of contracting, normal contracting going forward, absence the thing moves on a step. But as long as it stays here, I think we're probably okay.
It's perhaps part of regulatory in general. Deborah, do you want to add anything? Or?
Well, I think it's an area that's going to get considerably more focus, not just as part of Brexit, and that's sort of back to the comments even of Lord Hill and some of the other participants around looking at GDPR in the context of the use of DLT blockchain. So the whole cybersecurity data, GDPR, this is all coming into sharp focus. So in some ways, the debate, yes, it'll be simple on contract, but the debate is moving into much more complex territory. And that's why we need to be back at the table all talking. And this is where we need the brain power. And I mentioned earlier, about those industry bodies when I was in London. And indeed, I used to go to Brussels and Paris, and indeed Lux and Netherlands and Sweden, Greece and Hungary. But when you have so much resource, as the UK does, to throw behind a number of these industry bodies, to lose that thought leadership is quite tricky as we start moving into some of this really complex territory. And that's not to say any of the other member states are not really throwing some important intel. I mean, Germany's been great for driving custody in this area. Lux is doing great things. Ireland has been great, but the UK for so long in financial services, let's forget the politics behind Brexit, has been a strategic partner. So we still need that discussion to move into that territory, because that's an opportunity.
I think that was one of the messages from Lord Hill. Christy or Valerio, do you want to comment on anything that's been said recently?
No, but I totally agree with Deborah. I think these are issues that will be tackled somehow. There is no doubt that a solution will be found because it's in the interest of all parties. I'm not a huge fan of GDPR and the way it is implemented. I think very few lawyers are, apart from those working in GDPR, because certainly they are making good money out of that. But it's true that, let's say, you always find a solution for GDPR. Just need to have the right systems in place, I mean, considering that, as mentioned before, financial services are being carried out from US. There is no reason why they cannot be carried out from the city.
We do have one more question from Arne, actually. In fact, he asked it in the earlier panel. To what extent is regulatory heterogeneity across the EU27 a challenge for UK exports of financial services? I mean, what happens when we have different regulation? Does anybody want to have a go at that?
Sorry, can you repeat the question?
Let me see. To what extent is regulatory heterogeneity across the EU27 a challenge for UK exports of financial services? I guess what he's meaning is what happens if we have different regulatory systems between the EU27 and the UK. Is that a problem for UK exports of financial services?
Well, I think it's not going to happen, in the sense that, as Tom and Deborah and mentioned before, but also Lord Hill. I mean, there is no also Lord Hill. It's clear that London will continue to follow or to adapt to the EU regulation, but simply because EU regulation will be adapted to global standards. Yeah, so I don't think it's going to be an issue, but.
I mean, what I think Lord Hill was implying was that in new areas in particular, you know, green finance, perhaps AI, perhaps some fintech, the UK might diverge significantly from the EU27. And I don't know whether any of you think that's likely to happen.
Well, I think it is definitely going to happen. And it's, you know, you've got to remember that there's the prudential role of the regulator, and then there's the consumer protection elements. You've got, I think, the regulatory at the top level will all stay on the same pitch, because we don't want to go back to pre-2008. So financial stability will trump everything. But at a local level, the appetite for individual countries to allow consumers to participate in, you know, crypto assets, et cetera, will evolve. And I can't imagine that the EU will drop anything onto everybody, because it'd be too complex. There'll be some overarching guidance, which then people will choose to enact locally, perhaps on crypto or something like that. In which case, you know, UK participants, if they want to distribute into those markets, will have to jump over that barrier. It'll be a cost to distributing into those markets. You'll have to understand it, and you may have to go into a, you know, either some sort of third country branch to participate in that market, or you know, another way of entering the market, and that'll just be seen as a cost. And you know, if the opportunity is attractive enough, the benefit will outweigh the cost. If not, they'll just miss it they'll forgo it. So if it was a small consumer market, they may say don't want to do that. But if it was like the Italian with a huge saving regime, et cetera, they say, well, actually, that's something we are good at, and the costs to get into the market and enact legislation and fulfill the local requirements is something we can do because it's scalable.
Can I maybe jump in
Please.
there as well? So this is really, really a fascinating area to me. So currently, in terms of digital assets, so we're talking crypto assets. So it's got various terms, but we're talking that have underlying cryptography behind it. So crypto assets. That we have MiCA, which is a European legislation, and DORA coming out, and that's anticipated for 2024. So people have this window of the next couple of years because there's a fragmentation in Europe at the moment, and everybody's trying to get ahead of that, right? The UK has had for years its regulatory sandbox, and it has certain benefits. EU has adopted something similar, and that's coming out. But as I said, Germany's got ahead in terms of its crypto custodians. France, I think, has got certain tax legislation. So there's been this fragmentation across Europe to try and maximize this opportunity. So does that slow things down? So that's one thing. And then we're looking at other pieces of legislation like ESG or AI. So one of the things about the adoption of AI, machine learning, that while the technology in some places is very much there, people aren't adopting it because there's not a consistent approach and they're too concerned about the risks. So that's why the EU digital package will actually enable that technology to be adopted much quicker. So everybody talks about the person who was done for a traffic offence because a camera misread some numbers on their shirt. They weren't even in a car for some traffic offence, or there's some horrible case law in this area. But so that's why some of that global standard, if you look at even in the crypto or unregulated space, some of these entities are having difficulty even opening a bank account. So it doesn't matter, that it may be unregulated, so the opportunity is not there. So and as I said that before this talk, there's been such massive developments at such a rapid speed. And then in terms of what's been done with MiCA, moving to trilogue, and packages being agreed, the regulatory sandbox, and then separately on ESG, that's a very interesting in terms of the sustainable finance package at a European level, because really, you have the regulators coming out at given guidance, but the barometer of what is correct may be driven by the market. And even on just investment funds perspective, we are seeing, say, the EU taxonomy or the sustainable finance disclosure regulation, that UK funds are sometimes adopting similar types of disclosure because, there's a lot of benefits with this guidance. This is not to say something negative about the EU or the UK, but we're better finding some form of agreement and sharing that knowledge and that intellect, and we all come with something to bring to the table.
If only politics didn't get in the way. I think, Federica, we are sort of more or less out of time, but I was going to suggest, if we don't have any other comments or questions, if any of the panel would like to say any sort of final quick remarks. I mean, let me make one very quick remark back to the question of why financial services played such a small role in the negotiations. And I think that spills over now. One reason I think that was true was that financial services, and the City of London in particular, are very politically unpopular in the UK. The City of London was also quite unpopular in Europe throughout Britain's membership, because the financial services industry is not a much loved industry. And that has been particularly true since 2007 to 9. When, we know what happened. And I wonder if you all would share my view that that's one of the problems. We all probably think financial services is important and valuable, but a lot of voters out there think it's terrible. And that makes making progress in this area, and indeed working together, much, much harder. Anybody want to comment?
I will. I think I'm always reminded of Animal Farm, 2 legs good, or 2 legs bad, 4 legs good. But the financial services is not all the same. There are some entities like depositories in the funds world that weren't involved in the scandal, and we can't compare every institution in financial services. And financial services in Ireland, propped up the economy through various downturns. And part of, there's a report commissioned every year recently by Irish funds just to show exactly what financial services is doing for the economy and for other people. And it's part of that education process. So it's not like for like. And as I say, sometimes you have to explain that these things are very different.
Yes, not everything.
I've also explained it to my nephew one time. I don't get those banker bonus.
No, quite. Anybody else? Any closing thoughts, including on that general theme? Christy?
Yeah, I would just follow up on what Deborah said. The fact that we need also to acknowledge what the progress has been, the progress made overall at the global level, at the EU level. Then, I mean, the UK and the EU, as Lord Hill said, they are both part of this Global Forum, where we are trying to have some standardizations on principles which are supposedly making the system function better and managing and monitoring risk in a better way. So this is where everybody could maybe be less critical towards those entities, meaning that maybe they were behaving badly for a certain amount of time, but with what's going on in terms of regulatory framework, supervisory architecture, there is huge improvement, and also in terms of contribution they can make to society. And I mean, we mentioned several times ESG, so green finance, sustainable achievements that can be made in this sector. It's huge and it's ongoing. I mean, there are many discussions. It's not today's topic, but there are many way forward in this regard. So
there ought to be a win-win there. Valerio, do you have any last thoughts?
No, I can just add, based on experience, on following also developments in the drafting of European regulation, that my gut feeling is that there isn't much literacy on financial services regulation at the level of politicians. Let's say there is probably a lack of interest and lack of acknowledgement of the importance of the industry in financing the real economy. I make the example to my juniors in this respect of the developments in the prospectus regulation and in the EU securitization regulation. The latter one is particularly interesting, and I will not make it extremely boring and long, but there was a proposal of the Commission, then a counter proposal of the Parliament, and then the Joint Commission came up with a completely different draft that was, let's say, clearly drafted by someone who understood a little bit about the matter. Because, well, at the end of the day, something had to be done.
Yes,
so,
very good example. Tom, any thought?
No, Chloe. I mean, I'll take you right back to you. You made a comment earlier on when you made your introductory comments about some of the debate in Dublin was excellent in the run-up to Brexit. It took me back to, I had Gerard Lyons and Ken Clark and Simon Coveney, and I brought in all the Irish press, and we had, sort of 400 or 500 people there. And it was a fabulous debate, and I only wish I brought the British press in. But that's hindsight, unfortunately.
I can only agree with that. I mean, I remember at that time in 2016 writing pieces in my admittedly not terribly widely read journal saying that if we voted to leave, there would be a massive problem about the Irish border. But the Vote Leave campaign just consistently said that's Project Clear. And, we know where we are now. Federico, I'm going to hand back to you. I think we've probably had a great afternoon. Yes, thank you very much to the panel. But Federico, maybe you'd like to close us down.
Well, yes, thanks, John. I want to echo what you said and thank all the panelists. And I want to thank you for chairing this event. It's been a fascinating discussion. I think we had a very rich set of speakers from Great Britain, Ireland, Northern Ireland, France, Italy, Luxembourg, politicians, academics, practitioners, journalists, lawyers, bankers. So I think it was really an excellent way to bring together multiple point of views on this important topic. I'm only really sorry that Lord Hill was not able to connect through its image. I think it's the first time in over almost 2 years of online event that we didn't manage to solve a technical problem of sort, but listen, those things happen. In any case, what I would say, following on what Tom remarked in his comments, indeed, we are not in a post-Brexit world. I think the title of this event might have been on purpose a bit provocative. After Brexit, we're definitely not after Brexit. The process is still very much going on. And so what I can tell you as a last word is that the Brexit Institute is still here. We're going to do more events to look at this. This is our last event for 2021, but please stay tuned. We will catch up early in 2022, and I really hope to see you all there at our next event, whether it's online or in person. Doesn't depend on us, of course, but With that said, I also want to wish everyone all the best for the incoming festive season. And once again, thanks to all of you for being here this afternoon.